The Rebel Capitalist Show.
Everyone likes to just try to figure out, okay, is the price of XYZ going up or down? Is the price of Tesla going up or down? Is the price of, fill in the blank? But they completely forget about, okay, how, if I buy this or if I short this, how does it interact with the other assets that I have in my portfolio? And how diversified am I? And what is my volatility risk here? Because if you want to reduce your volatility, well, then you can just reduce your position size in something that might be extremely volatile, i.e. Bitcoin. So how important is that? And maybe am I overdoing it? And what did you do to try to manage that portfolio construction well?
Well, I think it's a really good point. And when I was running my short fund, one of the things that I did, because I would a lot of times be all concentrated in one area. One of the things I did was I said, okay, look, by definition, like Warren Buffett, one of his expressions was, put all of your eggs in one basket and watch that one basket very carefully.
Yeah, right.
So on one hand, he's saying, well, you got to concentrate, and on the other hand, other people say, well, you got to be diversified. Well, you can do one or the other, a bit of both, but you can't use the same tactics with each strategy. So if you're quite diversified, you don't have to hover over your stocks quite as much. If you're all concentrated in one area, you have to be much more proactive about managing your risks because you don't have any diversity. I mean, if you're wrong on your idea why you're ganged up on these things, either long or short, you're in big trouble. So what I did when I was running my short book is I kept my funds small. I never got much over about $175 million because even with leverage, I could get out of all my, I had different rules. Like I didn't short stocks that were single digits. I didn't short, really broken or the, what do they call it? Value trap. There were things I never did just because I thought I would wind up getting too much, taking on too much risk. And I wanted to be able, the reason I kept the fund small was because I wanted to be able to be out of everything in a couple of hours if I decided I was wrong. There's nothing worse than knowing you're wrong and not being able to get out of your positions. That's like the worst feeling ever. So
what are your thoughts on what happened with GameStop?
I think that it was a combination of events. It's a manifestation of the environment we're in. With the again, combination of indexing and then the derivatives market, and then the public, for this moment in time, being keen on the market and the online effect and all that. It was like the perfect storm showed up, and it hit in a way that caused that to happen. We got a preview of that last year when the Hertz went crazy, right? And of course the mainstream media never is accurate about short selling. I mean, there's all kinds of short sellers. There are guys that are short in the capital structure. They're short the equity because they're long the bonds, right? They're basically workout artists. And there are people that are fundamental shorts, like I used to be. And then there's what Mark Hodes calls the smash and grab, right? Where they issue a big negative report with a lot of splash, and then they get big in front of it, and they take it off. So the latter kind of guys tend to give the whole community a bad name. I was always quite vocal about what I was short because I thought I'd uncovered problems, and I was, alerting people. Obviously, if I was right, I got paid. But other people, like I remember I had one jihad against Gateway Computer. I don't know if you remember them. Well, they were cooking the books. Yeah. And I'd been after them. And then finally, Gretchen Morgenson wrote a big article in the New York Times, and ultimately the SEC got them. Well, anybody who listened to what I had to say saved themselves a lot of dough, right? So I've gotten off on a tangent, but so what I used to do is I regulated I had other rules too about when I would be short and what were the right conditions and when did I have to be extra careful and all that. But I think the important thing is for people to realize that you have to use different tactics. If you're investing or if you're speculating, if you're trying to go long term or you're trading, all these different things require different sorts of tactics. And I think a lot of people have learned the wrong lessons because of sort of the unprecedented mania we've had at different uh, um, force levels, if you will, in the last 20 years. And people have been rewarded by sort of trampling all over the laws of financial physics, if you will. They've gotten away with it. So they've learned the wrong lessons. And at some point, that's liable to be quite expensive, I think.
Yeah, and they've been trained that just pretty much everything works. Just
Right.
like Portnoy,
Right.
you know, just throw a dart,
Right.
buy it, and sooner or later it'll go up. You know, one thing that Jim mentioned on the GameStop thing is the short interest. He said shame on Melvin Capital or whatever, because whenever
Right.
I would go in there, I would look at the short interest first thing, and you would try to, you'd know which one could blow up in your face, and you'd stay away from it. So did you
That's
look
a
at
really
that
good
as well?
point. Yeah. That's a really good point. So I told you certain things I didn't do. I would always check the short interest to see how crowded it was. And really it's the short interest vis-a-vis the float that you got to worry about, not just the overall short interest. And again, if the Fed is printing money, it's very difficult to make money on the short side. If stocks are hitting new highs individually and as a market, it's difficult to make money on the short side. If stocks don't respond to bad news, difficult to make money on the short side. I mean, you put those few things together and a few other simple rules, and you can at least keep yourself out of trouble. And those groups of rules would have kept you from trying to short much at all in the last decade or so. I mean, last winter I got short pretty aggressively. I've tried a couple of times when I could see what was going on in China and the market didn't care. So that was one of those times. The market structure today is such that it's crash prone. But to really get a prolonged bad market environment, I think you would need to get layoffs to get to the point where the 401k automatic, retirement date funds that are feeding the market, slow down or stop or go the other way. Or if the bubble gets big enough that even the amount of monetization that we're doing isn't enough. We've never seen that before. Every mania in history, or certainly every mania of the last 100, well, let's say since 29. You look at 29, you look at 69, you look at 87, you look at 89 in Tokyo, and not really 87 so much, but you look at 99 or 08, you had periods where there was this massive euphoria and people believed that financial gravity didn't work anymore and they didn't have to follow the rules, however you want to say it. But into those periods, the central bank had always been withdrawing some liquidity. Now, maybe they weren't doing it fast enough, and that's how they created the bubbles in different periods. But there was some level of that, and then the crowd would continue to be crazy, and the mania would exhaust itself at a time monetary conditions were unfavorable, and the thing would collapse. Now we've got an environment where they've told you we're not even going to think about taking away any of the stimulus until well after inflation has hit our target, which, oh, by the way, we only made up in the last 10 or 12 years. And so there's no telling how crazy things may have to get for the equity market to finally tip over.